Hello. Today I'm going to answer a question that was given in the support server by Bobo. Now I answered it in the support server itself, but I kept going back to it because I don't believe the answer really justifies a proper response to the question. The question itself is what Jackrabbit strategies would have survived the recent bearish market from November until recently. And even when you look at the chart in front of you, it still looks like the bearish market is underway. Well, basically, any and all Jackrabbit DCA strategies would survive with no problems. That's the short answer. And that's 100% correct. It's also 100% wrong, because it's missing a lot of context, particularly the context being you, the investor. Any dollar cost averaging approach will work, guaranteed, within a reasonable margin of error, as long as you have enough money to see your way through it, and the asset doesn't just completely go apocalyptic like Luna did. Realistically, while the short answer is yes, the long answer is much, much more complex, more difficult, and really deserves a much better response than just yes. Because in reality, the answer could very well be yes, it will survive, but no, you won't. That is a major issue and context that we need to really get into. YouTube is filled and littered with videos of people supposedly making $20 to $52,000 in one account. But there's a context that's missing from all of that. How many losses did they take to make that $52,000? Do they still have that $52,000? And do they actually take into account real world exchanges where you pay fees both for purchases and sells? 90% of the videos I've watched on YouTube actually don't count fees. So if you don't count fees, anything's going to make money, just about. But realistically, the real world, even a winning trade can become a losing trade as soon as you pay your fees. So the question for Bobo, or I should say the answer for Bobo, is it depends realistically on your portfolio, your coin choice, your risk assessment, your risk mitigation, and how well you prepared for the market in the long run. That is really going to be the biggest question in terms of whether or not you are going to survive a bear market correction of the magnitude we've had for the last 8 months. And that brings us to a whole list of other questions in terms of what approach is more likely to be successful compared to non-successful, or what approach is likely to not cost as much money, meaning less accumulation. Now, I'm specifically holding this context to dollar cost averaging with no exit points and no stop losses, because realistically, those are the ones that are most likely going to be successful. An exit point and a stop loss is an automatic guarantee of just that, a loss. Now, that's not always a bad thing, and that really, again, depends upon your personal situation. But this morning, I spent some time really going over his question in detail. Bobo gave a question that seemed simple on the surface, but in reality, when you really think about what he is asking in the context of not just a reasonable budget limitation, but a reasonable productive process that can weather any market condition. You see, if we could all go back 6 months to November 14th and open up a bucket load of shorts, well, people who wanted to trade Bitcoin could short it and they would be very wealthy right now. And that's where these videos also manipulate and mislead people. They come back after these bear runs and say, see, if you'd listened to me 6 months ago, you would have this much money now. All of that nonsense is just that. Nonsense, crap, rubbish, outright filth on the market that really doesn't belong there. That kind of nonsense is just pure wrong. And that's what causes 90% of the losses in any market is people peddling this garbage. The reality is we don't know what the market is going to do. We never know what the market is going to do. Here's a good example. People thought this was the bottom of the market and that the next push to $100,000 was going to magically occur. And it didn't. It turned into a sideways market that then turned into a deeper bearish run. And even here, we've hit the bottom. Load up. Get ready to go to the moon. The train's getting ready to take off. If you're not on it, you're not going to be on it. You're going to miss out on a lifetime. And lo and behold, another rock bottom drop. And we are again in a situation where the market is leveled out and could potentially go up. It could potentially go down. If you look at where market momentum is sitting right now, it looks like it's going to continue to go down. Realistically, some economists and crypto speculators that are legitimate said that we could very well be in for another 2 years of this corrective market. I don't know if that's accurate. What I do know is that realistically the only bottom to any market is zero. Anything else is just a plateau and an opportunity. And bear markets are some of the best opportunities on the market. Bear markets represent the corrective phase where greed gets eliminated. People start acting stupid and they do emotional nonsense that gets them wrecked. Smart investors, people who have planned out their risk assessment, people who understand their risks, their budgets, the long-term scope of what they are trading, they are going to see their way through it. They're not going to magically be millionaires, but they will see their way through it and they will profit. Through consistency, science, and math, proper trading on most reasonable assets are going to do well. Some assets like Luna and the corruption that went on behind the scenes, well, nobody can forecast that except for insiders. And they should all rot in jail next to Bernie Madoff. But that's a whole different topic. For now, let's just talk about Bitcoin, the bear market, and what I came up with this morning to demonstrate just how anybody can survive a bear market. but that survival rate depends on many critical and key factors. Hopefully, Bubble, by the time this video ends, you will have a much more defined answer to your question that will provide you with the tools necessary to make more informed choices for your personal situation. So let's get started, and I've actually set this chart up with something very unique, something I don't usually use, but this particular recipe that I'm going to give you works well with it sometimes. Sometimes on a lower time frame, it's a hot disaster, but sometimes it does very well. So let's get into the chart itself on the 5-minute, and let's unveil the strategy. Now it's dollar cost averaging, of course. And let's actually turn off dollar cost averaging and turn off the parabolic stop and reverse. So here's the momentum. I'm actually using 2 levels of momentum. Let's zoom in on this. In fact, let's go back to the 4-hour and demonstrate why this is so important. Let's take a look at this run right here. As we can see, starting right here, momentum climbs. It hits, it crosses, it starts dropping. So the cycle of a downtrend. Now, from the standpoint of my personal trading, I generally don't short at all. I prefer long trading even in bearish markets just because I want to hold the assets I'm trading. That's part of my risks that I have to consider when I trade. A lot of assets don't deserve to be held or traded actively in a long state during a bearish market, but I prefer it for what I trade. And as you can see, this process demonstrates a relatively consistent pattern. No purchases take place when the market is dropping. That's what I want. I don't want any purchases unless it's in an uptrend. So this is a trend following approach. Now in trend following approaches, the longer the time frame, the better the trend. As you can see, just getting into the trend here and getting out up here would have been a profit with nothing else. But that's not all I'm doing here. I'm using a 20 line, 50 line moving average crossover process as a filter to the trend. This allows me to actually only look at the market in a way where I can try to catch these up runs. That is the crossovers. But I only want to purchase when price is above the momentum. That is, if the price is below the momentum and the market is going downward, I don't want to take on unnecessarily or risky accumulations. So now the next step is, of course, the parabolic stop and reverse. And it is really a good indicator that shows up some very interesting facets. In fact, I'm going to disconnect it from the chain so you can see it in general. The screen would work. Now let's zoom in. And you can see the parabolic stop and reverse. Picks up on a bottom and closes on a top. but it doesn't line up with the momentum or the moving average very often. And that's exactly what I want. So let's put this back in place. And you can see that you don't see the orange triangles very often. They just don't show up very consistently because the market has very strong filters. Parabolic stop and reverse is a wonderful tool for really filtering out and looking at market changes dynamically. Many people consider it a trend following tool. Many people use it for scalping. It's a very versatile indicator when used properly. As you can see here, it signaled a sell point. Now, this is an accumulation strategy. So we have dollar cost averaging. And as you can see on the 4-hour chart, this made 2 trades. That's not overly impressive. And for the 4-hour chart, really, this is overkill unless you're using extremely large budgets. Where this approach shines the best is the 5-minute chart. Again, only 2 trades for 75 days. But because it's accumulation, you could even go down to the 1-minute chart. But that's the benefit of accumulation. You don't have to worry about being perfect. Here's an example of an open trade. The trade is still open at the 1-minute chart. It has taken on 2 positions. That's it right now. The market simply has not been solid enough to warrant that context. So it is a very nice little approach. And as you can see, let's zoom this out. As you can see, it missed this entire down drop. Is it perfect? No, it's not. It has its own risks, and smaller time frames are riskier than larger time frames. But is it relatively consistent? Yes. As you can see from here, 2 positions total. It does well. The momentum keeps it from picking up too many accumulations along the way. You can easily set this at a fixed budget and never have to worry about it going over that budget. And that is really the whole point of momentum-based trading. Trade with the trend, always. So whether the market is going up, down, or sideways, these particular kind of approaches are really the most solid and the least amount of accumulation. But they are also typically the slowest. Two trades in 75 days. That's not going to make a lot of money. And even when you look at it, let's really zoom this up. This is a one-hit wonder. Only one position each time it's made a trade. That is really the best case scenario. You could take on 10 or 20 coins, run it through something like Jackrabbit Relay that only gives you 5 coins at once, and trade reasonably well with an extremely small budget. Or you can trade 1, 2, or 3% of your entire budget and come back with a huge realistic profit. For example, $1,000 budget, 1% of $1,000 is $10. 1% profit for every $10, you're looking at 20 cents profit. But that 20 cents profit gets added to the balance, and now if you're just trading percentages, you're going to compound your percentages over time. And this is going to work for every single asset you trade. Compounding will do wonders. But that's not all this approach is capable of doing. This particular recipe is unique because it has one other trick up its sleeve. A trick that really I don't talk about much because it's not within my risk assessment. And it's really not something I recommend to beginners because of the risks associated with it. So we already know that this particular approach is profitable. But a lot of people don't like dollar cost averaging. They want to get in and get out. They want a stop loss. I personally don't like stop losses for beginners because I think it can unnecessarily take on too much risk that they might not understand during the learning process. But for advanced traders that do understand their risks, they do go through backtest, analyze, and study, it can be a whole different world. But again, you have to understand the risks. In this case, the risks are a total loss. It may have only made one trade, but that one trade was a loser using a stop loss. Could it have been profitable? Well, yes, it could. You can change the duration of your support and resistance. You can use an ATR. There are a dozen things that can make this backtest profitable. But that's not going to guarantee that a future trade is going to be profitable. I've talked about this before with the deception that backtesting gives. And that's one of the problems with backtesting is that you can paint a false illusion of something that could be successful when in reality it's not. This is one of the reasons why I am not a proponent of stop loss versus dollar cost averaging. But this particular recipe on the 5-minute or greater chart does do well most of the time. And I think I'm going to go through and demonstrate that. Of course, some coins are not going to do well. But here you see it does well with this one. Now, reasonably speaking, dollar cost averaging is always going to be profitable within a reasonable level of certainty. Certain events like Luna collapsing, hardware failure, software failure, exchange maintenance could make that not profitable for that moment. But through the law of averages, dollar cost averaging will always be profitable. Stop loss trading for automated trading is a whole different world, and more often than not, it is not profitable in the long term. When I say long term, I'm talking 100 or 1,000 trades. Rare occasions, rare combinations like this one paint a different story. These are the exceptions to the rule, and they're hard to come by. They require a lot of testing, a lot of understanding, and careful study. Realistically, no market is perfect, and sooner or later, this approach is going to have a loss, and that loss is going to be heavy. The trading process between short-term and long-term boils down to two different ideologies. Mean reversion, which is always short-term, because trend doesn't work well in the short term. It just breaks down because the market is too chaotic. And longer trends would be the trend itself, or excuse me, longer time frames. Some would say that starts at the 15-minute, but I've personally found the 30-minute to be when stable trend trading begins to really show positive roots. But that's only good if you have the budget to take on large position sizes. If you're a retail investor or a retail trader that uses the 5-minute chart, the 1-minute chart, typically speaking, you're going to need something that does well on the short term. And you're going to have to accept that short term is relative in the context. In this case, this is a 75-day analysis. Only one trade in 75 days. That's not all that great, but it's profitable, and that's the point. If you trade by the numbers, then you trade by reality. And here is a good example of a coin that had 3 wins and 1 losses. That 1 loss really hurt the profit. As you can see here, 0.2% versus what do we have here? 1.5% with accumulation. So that should tell you that is a very real world problem. And this is why dollar cost averaging is always the best approach for a beginner or somebody wanting to survive a deep bear market. While this is an acceptable approach, meaning the stop loss, as soon as I find my mouse here, this is acceptable. It is profitable, but it's barely profitable. One trade caused chaos. One trade took a hard loss and it wiped out almost all of your profits. So there are risks associated with using a stop loss. Very important risks that need to be studied, even with a one-hit wonder that is pretty much a gold mine in the market. Dollar cost averaging has its own risks as well. Luna, again, is the example of just how bad, and probably the worst case of anything, the apocalypse of the coin. Complete liquidation of it, complete destruction of it. This is the biggest argument against dollar cost averaging as a whole. Many investors say the uncertainty of the market is why this is a good day over this. I personally disagree. I think the long term of the market shows higher market cap coins overall are going to survive. You're not going to get rid of corruption. Whether it's Luna or somebody trying to cannibalize Ethereum or cannibalize Bitcoin, it doesn't matter. There's always the risk of some large institution trying to drive an asset into oblivion. In Luna's case, it was its own owner through insider manipulation. But nonetheless, it can happen on any assets on the market, realistically. So let's see if we can find the profit-killing loss that pretty much destroyed this asset. Now, from an aggregated situation, is this asset worth trading? Yes. And a long term, again, 100 or 1,000 trades could be a whole different context for your personal risk assessment and situation. A stop loss may very well make sense in this situation. Risk versus reward, and that is a viable and legitimate concern. The amount of risk needs to justify the reward, and you may not want the kind of accumulations that you see at the top with dollar cost averaging. There are advantages to one position trades. There are disadvantages. Only you can truly decide. As I said in the beginning of this video, if we could all go back in time and redo our trades, we would be millionaires right now. But we can't. And realistically, that is a true and real problem. And here is the trade that took the loss. Let's zoom this in, see if we can find out. Okay, the red line is a stop loss. Let's zoom this in more. Black line is price action. And then my mouse will cooperate. $2.98. So let's go back. $3.06. So 2.98, 3.06. That doesn't sound like much of a loss, but apparently it was. Let's see. That was a 1% loss. But you add fees to that, and you're looking at a 1.2% loss. And that can add up over time. Is it worth it? I don't know. For me, the answer is no. For you and your personal situation, the answer may be yes. But that's the whole point of trading. Understanding your risks. And that's why a bear market is really the best place to make money. Bear markets are when money changes hands. The only question is, are you going to be the one to lose it or gain it? Bear markets are an equalizer. They are the time when you see whether or not you've done all your planning properly, whether or not you've made the proper choices in your assets, in your risk approach, in your budgets. All of that takes place on the bear market. Everything wins in the bull market, no matter how bad it is. That's one of the saving graces of the bull market, is even the absolute worst garbage approach is going to turn a profit, including just buying randomly. But that doesn't always demonstrate the reality of the market. In fact, it doesn't demonstrate it at all. Realistically, you must choose a standpoint of your market. Here is one where it only won one time and it lost twice. But if you look at dollar cost averaging, providing I can get it up, dollar cost averaging shows it won all the time because it only made one trade cycle and it didn't take that loss. Bear markets are really a godsend to the investor when used properly. The problem is you have to use it properly. Planning for a bear market is one of the most difficult processes you can do because you don't know how long it's going to last. A bear market might last a couple of days and then enter another bull market. And we've seen that countless times with Bitcoin's history. Then again, a bear market might last 8 months or a year or 2 years. There's no way of knowing. All you can do is plan for the worst case scenario. In my case, my worst case scenario would be 100 steps. That is bottom line. If I have $1 per trade, my worst case scenario is a $100 risk using accumulation. For something like a stop loss, you could probably use 1% of your account and take 10 or 20 losses in a row and still come out ahead at the end of the day with the right approach. Stop losses require greater thinking about your risk because you are physically going to take deliberate losses. They require more precision, a better surgical approach. Dollar cost averaging is a sloppy trading method. You don't need to be precise. You don't need to actually hit the bottom of a trend or the plateau of a cycle. You can recover easier providing you've planned for your worst case approach. So hopefully, Bubble, this answers your questions. Yes, any strategy that Jackrabbit uses that is dollar cost averaging based, even the most aggressive, will survive with the right budget. Strategies that do better are automatically going to be slower. Trend following strategies in particular that don't purchase in a downtrend are automatically going to be more defensive because they're not going to purchase until a market begins to plateau out or changes direction significantly. So that is the reality of trading. And I will put a link to this below in the description so you have this recipe to work with. This is really one of the few good recipes that does do well with both types of trading. It's not a perfect system, and no system is, but it does manage well its risks, its budget considerations, and the number of accumulations you take on. I'm going to continue to go through this a little bit more so I can demonstrate some of the coins in general. And as you can see here, this whole bearish downtrend completely missed. It got in on a plateau and it made a profit, both the dollar cost averaging and the stop loss. So again, using multiple coin approaches with just 1% of your budget and taking careful consideration of how many coins you trade. Overall, both are going to make money. Which one makes the most money really doesn't matter, because you, and only you, at the end of the day, have to feel comfortable with the risks you are taking. That is really the whole point of surviving a bear market, and why the influencers that riddle YouTube and all the other nonsense on social media are really just part of a scam trying to take your money, trying to convince you that they know what's best for your trading, when all they care about is taking your money for some ridiculous process that's not going to work in the long run. Jackrabbit does work because you can see it and test it yourself. You don't need a lot of complicated mathematics to figure out whether or not you're winning or losing. You do need patience. You do need to understand your risk. And that really is the number one factor I see, is people don't truly understand how much risk they can take. A lot of people, particularly in bull markets, will take on far more risk than they should, not thinking about the fact that sooner or later you are just one trade away from a bear market and losing everything. Whatever your risk is, quadruple it. So if you think you can handle 100 positions of a particular asset, think about handling 400 positions of that asset. Do you want to be in that particular asset for 400 positions? Does the market cap of that asset justify you putting that much money into one asset that might take months, if not years, to recover from a deep bear market? These are the kind of questions you need to think about when you're looking for the trading approach. The other thing that stands out a lot, and I have seen this countless times since I started Jackrabbit, a lot of people will take on a few losses and they think the strategy's failed, when in fact the strategy's done what it's supposed to do. The people were just impatient, or they got scared. When you pick a trading strategy and you've done all your research properly, the most important thing you have to do, especially in a bear market, stick with the strategy. Because more often than not, a very well-developed strategy will always come out better in the end than during the middle. That doesn't mean the middle's not going to take losses, but it does mean that if you change your strategy or your approach too frequently, you are going to take losses, because a properly built strategy, particularly one around momentum, focuses on the market when it starts turning sideways or uptrending. So really, two of the biggest things is people changing strategies too frequently and people not understanding their risks in a bear market. Trading cryptocurrency, or for that matter any commodity on the market, is a zero-sum game. Somebody is going to win and somebody is going to lose. The people that are going to lose are the people that let emotions get to them. They're the people that didn't plan. They're the people that don't understand their risks. The people that are going to win, they're the people that took the time to understand their risks. They took the time to test, backtest, study, analyze, and learn what they are trading. And most importantly, they have the patience just to leave the machine alone. Once they've made the commitment to put their money into the process. It's a matter of let the process work. You truly don't know if any indicator on the market is really going to work until you run 100 tests. At a minimum, you have to have 100 full and complete trades to know the true legitimacy of any approach on the market. And realistically, that is the only way to really consider trading. It isn't a hurry up and get rich quick scheme. Trading is a science. It's just as intricate and as detailed as playing a game of chess. The only case is you are playing against the exchange, and the exchange is backed by thousands of other people looking to go against you. This is where your strategy, your conviction, your budget, everything you have as a trader gets tested. Bear markets bring the greatest opportunities available because it shakes out the weaker hands. The problem is are you one of the weaker hands, or are you in it for the long haul looking to profit? Now everybody's going to answer the question and say they're in it for the long haul. But when they look at the market 6 months down the line, are they in it for this kind of a long haul, where something that they're interested in is going to lose 70, 80, or 90% value? Are they in it for that kind of a long haul? Are you in it for the reality that the market is simply not going to be ups constantly or sideways? It's going to have deep, massive corrections driven by greed and fear. Greedy people are going to drive the prices up. People that are scared of their own shadows are going to drive the prices down. That's the whole point of the greed and fear index, just to show in a meter how stupid people are. That index shouldn't even exist, but it does because people don't think about the consequences of what a long-term bear market really represents. It represents opportunity to the right individual. It represents choice to the right individual. It represents a way of building a position a person believes in. But for the person that doesn't plan, it represents ruin and chaos. For the person that's in it simply to get rich quick, it represents the end of their greed. Bear markets should not be feared. They should be looked at for what they are: careful and strategic opportunities. That doesn't mean that they're going to happen overnight, and it doesn't mean that you're going to get rich magically at the end of it. That means if you're smart and careful, you will make money. That means if you understand your own personal risk measures, how much risk is too much? Can you take 8 months of a sharp market like what we have in front of us? Can you take a 90% drop in the value of what you are trading? Do you believe in it that much that you're willing to risk 90% of its value to profit from it at the end? That is what separates the winners from the losers in trading. The reality that the market is a beast of its own, a hungry beast that will either reward you for your diligence or devour you in the process. Long-term bear markets are critical and very productive. But you need to plan well. You need to think about you, your own psychology, your own thinking, your own ability to research and understand what you are actually purchasing. That really is the first step to surviving any bear market. It's not about the chart. It's not about the strategies. It's not about the recipes. It's not even really about your budget. Although your budget plays a role, because if you're trading 4-hour time frames at $1 at a time, you're not going to make a lot of money. But the point is, it can be a winner or a loser, simply based upon you. You are the biggest risk in your trading. Your emotions, your ability to simply look at the market and understand that the whole thing can turn against you at a split second. You could go from making $1,000 a day to losing $1,000 a day for 6 months straight if you don't understand you. Automated trading is a wonderful tool because it can work 24/7. Automated trading is a train wreck in the motion because if you don't plan properly, it can lose your money 24/7. That is really the reality of trading. You are the beginning and the end of your success in trading. Not the fly-by-night piece of garbage preaching how they made $20 to $52,000 in 3 months. That's not going to get you anywhere. If anything, that's going to just lose your money faster. Because you need to understand what you are trading, how you are trading. That is where you make money. Now, I will leave a link to this particular approach in the description below. This is a one-hit wonder for higher time frames for both stop loss and dollar cost averaging. If you want to trade more aggressive time frames, then dollar cost averaging only. Trade smart, trade safely, and most importantly, don't fear the bear market, because this is where you are going to make real money if you are prepared properly. Like, subscribe, let me know in the comments what you think. Ask questions about the approach. Until next time.